Please, whatever you do, do not fall for the next trap. Do not become a bear stuck in denial as the market grinds higher. The major failure from the sellers on Thursday leans more towards the capitulation low being officially set. Now throw in a headline like this over the weekend, and how could you be? Of course, there are still some threats that we're watching very closely, but remember that the market likes to climb the wall of worry. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points, including the threats, most importantly, and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on this lovely Sunday morning with the SPY monthly time frame chart. Now keep in mind that the April bars have not officially closed out yet, so the structure is subject to change. However, based on the longer lower wick, we can start to imagine that either buyers have stepped up towards the lows, or sellers are unwilling to sell more inventory towards the lows of this bar. The structure starts to look hammer-esque in nature, and that's a bullish indication. But what we care mostly about on the monthly time frame chart is the level of precision in which we've retested the previous high back here. Remember, previous resistance acts as newfound support, and we find ourselves a monthly high or low, especially when we make note that we've pulled back from the highest high in the trend count, and all of this is taking place above an upward sloping 50 SMA on the monthly. And if we zoom out a little bit here, we could also tie in trend line support with this trend line from the sickness low way back over here. So the monthly trend remains in the upward direction, but one more time, let's revisit. It's the precision of the retest. Notice that there is no overshoot here. We go straight to the level, and that's exactly where the selling stops and the buying potentially resumes. Just as a quick example, if the market's going to go to zero and everybody's concerned about some Armageddon situation, you're not going to have precision. This is the sickness pullback back here, where everybody literally thought that the world was going to end. There is no retest high or low long over previous resistance here. And you'll also note at the very bottom of the move, there's a pretty aggressive overshoot of the previous low. That's just not taking place in the current market conditions that we have in front of us. Let's take a look at the weekly time frame chart. And let's do what we typically do. Let's begin with candle structure and location on the bar-to-bar count. The candle structure itself is a solid green-bodied bar with a little bit of an upper wick there, but after a nearly up almost 11% day on the Wednesday session, a little bit of consolidation up here towards the highs as reflected by the upper wick is no big deal. As we're considering the candle location on the bar-to-bar count, though, it's not all rainbows and butterflies here. We still have a lower high and a lower low. The only thing I'll call out here that is slightly more bullish than bearish is the candle close being inside the midpoint of the previous week's range. After gapping down on the Monday session, you would think that stronger sellers would achieve a gap fill reversal and close underneath the previous week's range, or even just in the lower third of the previous week's range. Neither of those two outcomes happened, of course. The overall trend on the weekly has not changed either, and this is a threat that we have to contend with. We all know that this started from a weekly double top. Here was the neckline, here was a lower low, here is a lower high. Obviously, we've produced a big-time lower low, and it's still very possible that somewhere around 550, we see a lower high formed underneath this, now acting as a weekly balance and overhead supply. That's a risk that we have to carry forward. It would be much more bullish for the weekly chart to start spending time over 550 inside of this prior consolidation range, and we'll watch out for that. Now, one thing to keep in mind here as well is the classic saying goes, bears sound really smart, but bulls make money. So because of the size of the range down here, if volatility subsides, and we'll get to the volatility index as we move through today's analysis, don't worry. As and if volatility subsides, what I think we want to be focused more so on is not necessarily the threat of the lower high, but the opportunity for a weekly higher low to start the trend reversal if it is going to be underway, right? We talked about the precision of the monthly. We talked about the sellers failing the gap down here to close prices underneath the previous week's range. Yes, there's still a bearish threat, but let's put our bullish hat on here and think, what do markets tend to do 80% plus of the time? Trend in the upward direction, right? Let's not be blindsided by some of the other technicals, though. Let's come in here with the fibs from the high down to the low. You've got maybe a small, I would not look at this and say it's the most bullish indication ever, closing over the 38.2. We're basically right there. I would want to see much more price acceptance inside no man's land, or pull back for a higher low and just not revisit this. But we have to take this chart somewhat at face value, right? If you're thinking about what is this, It's technically bear flag consolidation if we remain below the 38.2. If you want to just focus on the last leg lower from the lower high, a little bit more constructive from this view, getting into no man's land and even testing over the 61.8 in the upper wick of last week's bar. Let's zoom out here and throw on our anchored view apps from the weekly perspective. And what I'd like to call out is that we are still over the 2022 anchored VWAP low. We're over the weekly 200 SMA, that's the green moving average on the screen. And with the gap down open underneath this high anchored VWAP, this low anchored VWAP on the Monday session, once again, stronger sellers probably should have sought a lower high underneath previous week's range, especially with the confluence of that anchored VWAP. One more time to acknowledge some of the threats here, the anchored VWAP cluster that sits above us is barreling down on that 550 level, which will be a major threat. That's supposed to be a 550 level will be a major threat on the weekly chart as we're walking forward. Let's take a look at the volume profile to be extremely thorough in the investigation here. And what I'd love to point out about this is actually a little bit more bullish, right? If we take this high volume node across, one more time, we opened on a gap down Monday. Stronger sellers should have used that as resistance. It's simply not the case, and we do see a stronger candle close above. Even if you want to take the top end of that high volume node and sort of parse it out a little bit further, we've closed over that as well. So generally speaking, I do believe that the next priority is seeking some sort of monthly higher low. Well, we've seen the monthly higher low, rather weekly higher low with respect to a lower high. You can get the lower high, which is fine, but as in if we pull back, it's all about using this as a reference. As long as we don't go here on the weekly time frame, I would have to imagine that we want to start becoming constructive for the capitulation low being in and working ourselves back into a weekly uptrend. Let's take a look at the daily time frame chart and see what's going on from this perspective, where we can start to see, honestly, some of the exact signs we were just talking about. Now, keep in mind, we have a shortened trading week with Good Friday on Friday. Quite literally, market will be closed. So we have a short week, and here is our expected move for the week. If you're not familiar with the expected move, check out the video tutorial in the top right-hand corner. So 4 days worth of trade, it looks like the range has compressed here, maybe a little bit, but again, with only 4 days, it's still a pretty impressive range. We have 558.88 on the upswing, which would be a higher high relative to Wednesday's high. And that, of course, is a bullish indication starting a little bit more of a short-term uptrend here. If we think about the lows, it's at 509.12, and that, of course, is a higher low. Once again, a little bit more of an indication of a short-term uptrend that's starting to try to form here. The expected move strikes me as bullish for that reason. And once again, thinking about a monthly higher low being set, thinking about a weekly higher low as the next priority, the daily higher low is going to play right into that same exact sequence we just saw on the weekly. Now, what is it already starting to look like? This was a 3-day balance range here. This is the Monday gap down where everybody over the weekend was, oh my God, these tariffs are worse than we could ever imagine. The China retaliation is so bad, right? Remember, we've talked about this, the FU scale, not literally FU, you guys know what we're talking about here. It's the fear and euphoria scale. And we brought up that headline in the introduction for a reason. This is MF, max fear, okay? And this over here is little e and U for euphoria. Max fear, euphoria, and complacency is smack in the middle. The announcement of the Trump tariffs being way larger, and I know we've done this exercise before, but bear with me, right? Max fear is Trump announces tariffs, max fear is China retaliates, and we retaliate back with 145% reciprocal tariff. And now, with some of these technology components not being subject to the tariffs, that moves us much closer to complacency in the middle and some opportunity for a positive resolution out of the final sort of question mark in this tariff negotiation, if you will, around China. The market is moving here based on expectations. They showed you the playbook on Monday where there was the fake news headline about, hey, we're going to reduce tariffs and put a 90-day pause. Nope, we didn't say that. Nope. Then Wednesday they confirm it, right? And the market moves higher. I have to imagine that with this update over the weekend about some of the technology components on the tariffs, it wouldn't be unreasonable to see a gap up here as we come into the Sunday futures open as well as the Monday morning open. We'll keep tabs on that for the pre-market prep, of course. We'll be live at 8 o'clock as we always are. Monday morning, 8 o'clock Eastern time, come on out to the channel. We'll do the full deal. But so a little bit of a gap up here wouldn't be unreasonable. I think the point I'm trying to make is it would seem very unlikely that we open underneath Friday's low if the news cycle is improving in the more bullish direction for the market. So what does that start to do? If this was a multi-day balance, Wednesday breaks us out of that balance. It's not technically a higher high in the trend count because this was the first hourly uptrend that we saw. But now we've certainly pulled back. Is it reasonable that using the top end of the balance here, previous resistance, previous resistance, previous resistance, as newfound support starts to act as your higher low on the daily time frame to change the trend, I think the answer is absolutely. The reason I would say this, and as we noted in the intro, is Thursday, there was actually a huge failure from the sellers. We had blood red market internals. And as a matter of fact, what we're going to do here is just go on down to the hourly time frame chart. Let me show you this, right? This is a classic double bottom. We talked about this on Wednesday. We talked about, hey, here's your neckline, here's the breakout, a Brigade bolt retest over the top. That's much more constructive for upside, right? So on Thursday, when the market did not hold this on the initial pullback into 523.75, what did the market internals look like? And I know we're spanning a couple of the screens here at the same time, but that's fine. I really need you to understand it. Look at the internals tick on Thursday morning. This was one of the most brutal ticks I have seen in my entire trading career. Slam, like on par with, if not worse, intraday than what we had from the sickness when the market was just outright Armageddon to the downside, right? Limit down many, many days. So this tick slammed into negative 1,000, negative 1,100, negative 1,200. As the market was pulling back, if I just zoom in now on the futures, you can see this. This is the pullback on Thursday, right? The market has blood red internals, blood red breadth. If we look at the advanced decline line on Thursday, blood red. If we look at the index score, this label is incorrect. That's from Friday. But if you look at the histogram here, it was underneath negative 15. So put yourself in the shoes of a seller. You're feeling pretty darn confident, right? What's the icing on the cake? We know that we had single prints underneath, right? This blue cyan box here, I'm going to go full screen ES for a moment. This cyan box right here represented single prints. So the fact that the sellers had everything going in their favor in terms of the market internals, blood red to the downside, looked into the single prints, and don't get me wrong, this is still a huge range. We're talking 5,300 down to the low at like 5,150, 150 points of range. Fantastic if you caught that as a short. But generally speaking, what should have happened when this took place? The market should have closed the single prints and gone all the way to the top end of this consolidation, and that did not happen. So because of that, the open then over 5,300 for the Friday session, we technically opened right at it. As we opened here and resolved this to the upside, that to me is much more of a bullish indication because sellers failed. They were unable to accomplish the full closure of the singles when in reality there's no structure here. As a matter of fact, let's just take it one step further. Here are the single prints, literally, on the market profile, right? H period single prints were not retraced all the way. Look at the volume commitment at price through this area. Look at the volume profile component. It's negligible. There's nothing there. You treat that like a gap. So the fact that the sellers were unable to do that on blood red internals starts to make this feel like a structural low as we go back now to the S&P, right? This is a structural low where the double bottom is in place. Yes, the neckline retest was not as precise as we would have liked to see, and we did have the blood red internals to support that, okay, the sellers are doing something here. The precision's much better on the monthly chart at this point, right? But regardless, you can't ignore the fact that this is still a low. This is an hourly higher low. This is still an hourly higher low. Yeah, it didn't happen precisely off of the level we're looking for, but we've got so much more information from the market on the idea that the sellers failed to do their job, and the market has now closed over that 523.75. That's the key level we talked about on Wednesday. So walking forward out of this chart, I think it's very straightforward. Any consolidation up here, now that we've experienced the overshoot on the hourly, is bullish. If we're over 523.75, I have to imagine that the market's in much more of a bullish state. What would the sort of target start looking like overhead? Well, consolidation, if you could buy it long off of this level, great. Retarget the Wednesday high / Friday low from back here, 541.25. Then we're looking for the gap to close overhead. It's the final piece of the puzzle, right? We closed on Wednesday, the Friday gap of the prior week. That would be an indication that, okay, the fact we did not struggle at all here, the fact that we did not struggle at all here, it's a bullish indication, right? A stronger sell-side market would have not really accepted over the top end of these highs. Stronger sell-side market would have gone gap fill reversal here, right, on the Wednesday session. It simply didn't happen. So all things considered, the pathing looks like this. Setting an hourly higher low is fine, over 523.75. Close the gap up here at 554.85. And we're starting to talk about, all right, we're testing the weekly lower high zone. That's where there's a threat. But do we want to maintain like a big bearish stance? Oh my goodness, the markets should crash and go to zero if the news cycle is improving, specifically around tariffs, which the market's been hyper obsessed with. If we've seen a technical recapture of this level, if the monthly precision is telling us that the market's not going to hell in a handbasket, if the daily trend is starting to change via a higher low in this area over here, after the hourly trend has certainly flipped to down here, right? We had highs. This is technically a lower high. This is a low, right? So you started to get an hourly trend change to the downside. I would start thinking of this zone as a daily/hourly high or low in combination at 523.75. So watching that very closely. What else can we do here? Of course, the Fibonacci goes on the Wednesday move from low to high, and we call out that we held the 61.8 on the pullback from the Thursday session, and we've closed over the 38.2. One more time, confluence at our key level at 523.75. Great. If we can hold there, looking for upside, looking for 550. Let's give this the respect it deserves, and it's very possible that there have to be maybe some nuanced levels here, as in if the market pulls back. One of the things that we'll find is if volatility contracts, and again, we'll get to the VIX chart in a moment. If volatility contracts, we're going to have to start throwing on a bunch of helper levels in here. You could expect the range to contract a little bit as well, and it's probably worth having, a technical level here, a technical level at the Thursday high of day to divide this range out a little bit. You could say something like consolidation here, Brigade Bolt is great. You could say something like a pullback here that then higher lows back above is awesome. I mean, we could parse these levels out if volatility ultimately contracts, but that's something that's top of mind, is having to add in some more levels as in if this becomes the structural low, volatility should decelerate, decrease, and ranges should tighten up here a little bit. Where's the bear case? Where is the bear case? If you wanted to try a big short on the gap fill reversal up here towards the upper edge of the weekly expected move, I wouldn't call that inherently wrong. I just wouldn't overstay your welcome, right? And the next step would be, okay, if you want to try to short this from here back down to 541.25, maybe the Wednesday high, that's not unreasonable, but I would not hold on to this thinking, oh my goodness, markets have to go here. The classic thing we do is we pick on the SPX 0 DTE traders, right? I would not fire up, let's go to the SPX real quick, and then we'll jump into some anchored VWAPs on the intraday. But the point being is, if you want to look for this gap close overhead as a failure, I would not use SPX 0 DTE, 5250 puts with the expectation that, oh my God, this has to fall in the money by the time the market closes. If you're looking for something that does this on a 0 DTE, I think you're approaching the trend wrong. I mean, yes, we can pull back here, but I wouldn't be looking for Armageddon style crash, right? The only way that would happen is if there is like an undo of the progress that was made on tariffs over the weekend, and maybe the administration decides to say, hey, you know what? Forget about it. We're going to tariff everything, electronics as well, and we're walking that one back. You never know. You never know. It's been a wild tariff ride, and I think anybody who is not open-minded to headlines changing the tone of the market is just not making. What would you say? You're not adapting to the current market conditions, right? Let's jump on into the anchored VWAPs intraday here. There we go. And what I want to highlight is just the fact that this is the all-time high anchored VWAP. It wouldn't be unreasonable, once again, for some pullback here off of the 550 weekly lower high zone. But this cluster of supporting anchored VWAPs below us is really what matters most next. Why would I say that? Because anybody who's short from up here off of the do or die zone over a week ago at this point, right? Anybody who's short from there is technically, the average price, not literally anyone who's short from here, but the average price since then is below. Look at the anchored VWAPs down here, certainly below. So the average short seller since that initial breakdown is now actually losing money. And as this cluster starts to creep in the upward direction, I thought it was going to happen a little bit sooner into the end of the week, but as it potentially takes place this week, it's going to offer confluence at that 523.75. So I think the game plan is pretty straightforward, right? As we've outlined, anything that's really in here is bullish consolidation, seeking upside moves to close the gap somewhere around 554.85, reevaluating up here for the possibility of a pullback, but then really looking for, again, another higher low in the hourly trend count. Pullback could look like this, and then we seek the do or die zone, right? If it gets worse than that, let's say that we get the consolidation, that's great. We break out over 541.25, close the gap, and then we reject hard for something that looks like this. It has to be a retest of 523.75, but one more time, make sure that you're trading this from point to point. Make sure that you're not shorting this up here with the expectation that we go here immediately as we still have 541.25 in between. If we get the lower high underneath, that's a different story, and then I would trade. So segment this out, right? You would short from A to B, then you would reevaluate at B. You would not just be blindly holding for an outright collapse. You would say, okay, if we get the lower high underneath B, then maybe we'll trade down to C here as the next possible area of support. When we get to C, this is where the thinking cap goes on and says, okay, lows, daily high or low, not maybe a little bit. Depends on if you want to count high, lower high, and that triggers the downtrend, right? But if we get an hourly downtrend to this, is a daily high or low available here, and that's the primary focus of everything we've been talking about, right? If you tuned into the Wednesday update video, this was like, okay, the capitulation low seems to have been set. And as of the next steps, the base case outlines we're looking for a pullback, and if we can support a higher low, we start talking about this as a structural low. It's not just a capitulation low anymore. It's not just a V-shaped recovery. We're also getting some sort of structural low out of it also. So that is those are the next steps. Those are the next steps out of our good friend, the S&P 500. We briefly talked about the internals here, the exchange level reads. Friday has decent volume inflows. I mean, this whole week has been crazy with just wild moves out of the internals on the extreme sides. I do like the fact that this tested lower off of the opening consolidation, then closed higher into the Friday session. I like the fact that the index score was strong, and I do like that finally the tick was not so depressed down towards negative 1,000. We actually closed the cumulative build flat, slightly positive here on the heels of that disastrous day on Thursday looking into the singles. So not out of the woods entirely, and there are some threats, as we've acknowledged, primarily that weekly lower high. However, the structural higher low narrative starts to come into play so long as price remains this week over 523.75, right? That's what I've got for you here. Let's quickly recap the market profile. There's not much nuance to glean here outside of maybe a poor low on the Friday session and just the idea that the single prints did not close as we've already described. That, of course, is a slightly more bullish indication. Trying to think of anything else to make note of here. Not seeing it. Value slightly higher on the Friday session. Point of control slightly higher on the Friday session, trying to build, once again, structural value in the upward direction and not have it revisit the distribution number 1 from that Wednesday morning. That's what we've got here. Let's jump on over to the nasty NASDAQ, our good friend on the monthly time frame chart. What do we have on the monthlies? How's the precision? Pretty darn good. Pretty darn good. So all the same comments that we had on the S&P apply here to the QQQ as well. A stronger Armageddon, oh my goodness, the market's going to crash and go to zero, is not going to hold up at a previous reference point. So precisely like this, there is going to be wild overshoot. There's just not going to be the first retest in the first place, right? If you do something that looks like this, there's your overshoot, and this actually did not hit the previous low here out of the NASDAQ. We know there was some semblance of relative strength, right? But the point being is this sequence right here is not nearly as precise as what we're dealing with. So I think that the market, emotion-wise, if you're talking about expectation-wise, is not quite the same as the sickness crash back there, right? Let's drop it on down to a weekly. Let's go through our top-down analysis here. Weekly bars, let's clean this thing up so we can actually see what we're looking at. Weekly chart, same concepts as the S&P 500. I won't bend your ear on that. Primarily focused on the close being inside of the previous range, not underneath the previous range, not in the lower third of the previous range. We do still have the threat of a possible lower high here underneath the consolidation, the weekly balance, which is still technically underneath the 50 SMA. If we check in on our weekly anchored VWAPs on the QQQ NASDAQ, what you'll notice here is we are underneath the cluster, right? The cluster still acting as that threat. One thing that we should do is pop one into the 1010 low of 2022. Let me just bring this to the 1010 low of 2022 so we can see that reference, 2022. Let's go 1010. And let's press OK. We are above that on the anchored VWAP spread here out of the NASDAQ. I did want to make the reference since we did do it over in the S&P as well. If we bring out the Fibonacci's from both places, we can start from the all-time high to the drawdown low. What you'll see here is we are right at the 38.2, right at this anchored VWAP. Once again, we have to call a spade a spade. If this does turn into consolidation down here, it is a weekly bear flag until proven otherwise. It would be better to get over that fib 38.2. If we come in from the lower high to the lowest low, what you'll notice here is a little bit of a different picture. We're over the 38.2, over the 50%, but still rejecting the 61.8. The next key step for the weekly chart, of course, is just getting some price acceptance over 470. If we get over 470, it starts to look a little bit more constructive in the upward direction from the higher time frame weekly. Let's take a look at the volume profile so we can evaluate that high volume node we were just looking at over in the S&Ps. It's this area right here, and notice that we're still technically underneath on the NASDAQ. So in the intro, I said that there were some threats. This is one of those threats. It's not quite as clean in the NASDAQ. You could do something that looks like this and say, here's a high volume node, though. We gapped underneath that, and we closed above. Yes, but relative to this range, right, the S&P certainly has a little bit more of a compelling story to be over its key level. Let's move on down to the daily time frame chart here. Let's reset it this way. Go to the dailies. Let's take a look at the expected move for the week. So here it is. Once again, a shortened holiday week here. So upper bound is at 477.61, a higher high relative to Wednesday's high, a higher low relative to Wednesday's low as well, but just the lows of last week. So expected move checks out as being bullish. If we're taking a look at the candle structure in particular, it's the same story as the S&P. 3 equal highs. This develops a balance range. Wednesday breaks out. And of course, the pullback here looked into the single prints just like the S&P did on Thursday. Sellers failed. And where did we close? Friday closes right at Thursday's high. Stronger sellers would have wanted to see on Thursday's session. Again, the easiest way to think about this stuff is to put yourself in the shoes of a seller. If you're a stronger seller and if you're of the belief that, oh my goodness, this market's got to crash and go to zero, what do you want to see on Thursday? Great. Oh, look at this. We're back inside the balance range. What does that mean? It means we have a look above and fail on the balance. The next step should be a lower high underneath 441, and we should rotate to the bottom end of the range. The question becomes, did that take place? And the answer, of course, is absolutely not. We closed up here towards the highs of the Thursday session on Friday. So walking forward out of the QQQ chart, I think the hourly chart is fine, considering the ranges we're dealing with here. Any consolidation preserves the exact look. That's over 441, under 453. Brigade bolts over 453 get us back to the Wednesday high. That would be up here towards 465.85, 465.85, yes. Note also that the QQQ NASDAQ closed gap number 1 and it closed gap number 2 on that Wednesday session. Stronger sellers should have produced gap fill reversal. Stronger sellers here should have produced gap fill reversal and not allowed prices to start working their way into a structural higher low. As we just talked about, right? The outcome should have been this for stronger sellers. So everything that I can see here starts to suggest that yes, the capitulation low is in, the news cycle is getting better, structural higher lows are developing, lows, higher lows, higher lows, and as long as that persists, there's really no reason to be an aggressive bear who is just stubbornly trying to push the market back in the downward direction. And, that was sort of the joke, if you will, of the intro. We'll certainly have to change our tone to being a little bit more neutral if we do fall back underneath 441. Let's draw that concession right now. Anything that looks like this, yeah, that's a threat. That's a concern. And the contingency plan in here is, oh my goodness, we have a weekly bear flag and it might possibly get worse. But what is added onto that contingency plan? Probably need another catalyst if the market is going to take out the Monday low, right? The reciprocal tariffs from China, the 84% announcement was not even enough to take out the Monday low when, everything was like, oh my goodness, I can't believe we just made it through the weekend. Let's sell everything on Monday. It's got, terrible, right? That's a classic sign of capitulation. So the news cycle would need to get worse for some unknown reason. The whole reason we call it a black swan event and an outside event is because nobody knows what that might be. But if something were to take shape like that, and it is worse relative to the news cycle we've seen, that's possibly where we start to see this lower high becoming a little bit more of a threat for lower lows in the overall trend count. But that's not the base case. So to get back to this theme of always outlining the base case says consolidation here is bullish. Brigade bolts over 453. I'm seeking Wednesday's high 465.85. Over that, looking for continued follow through into the top end of the prior range. We've been labeling it as the do or die. That's 480.25 towards the upper edge of the weekly expected move on the QQQ. If we do get some sort of breakdown underneath 441, this is not the base case, but we will have to change our base case if this happens. This is where the threat steps in. And again, you would have to see some sort of just new updated news cycle component, a new catalyst if this low from Monday is going to get taken out, right? So that is what we have on the QQQ. Let's quickly come in here with our good friend, the Anchored View Apps intraday. You can see the same commentary as the S&P, whereas any shorts, the average short seller after this last lower high is technically underwater based on the Anchored View App spread. People are more so content on the long side, feeling like this, rather than the shorts. And this is slowly going to provide confluence at the 441. That is all good and makes sense. 465.85 coming from the all-time high Anchored View App. Let's quickly check in on the fibs from the low up to the high of this move. 38.2 is slightly over the 441. I believe we checked in on that on Wednesday's midweek market update. So at this point, it wouldn't be, I would always favor the structural level instead of a fib. I'll just put that out there. So I'm still using 441, just making note that it's roughly an overshoot of the fib 38.2. Let's get on over to the NASDAQ market internals here. Oops, that's the same thing. That's the NYSE. Let's jump to the NASDAQ. And what do we see? So, okay volume inflows on the Friday session. It could be better. I do like the negative to positive flip out of the advanced decline line, and I do like the stronger cumulative build here out of the ticks down below. That is a pretty compelling look, especially on the heels of Thursday's session. One more time, it's the same story. I guess what we'll do is we'll look at this over on the market profile. Here's the NQ. NQ, stronger sellers should have done what through the single prints, right? If we just extend that on Thursday, when we were getting those big bearish impressions out of the tick, stronger sellers, Sally Shell, She Shores sellers, do that one 10 times fast on a Sunday morning. Thank you guys for tuning in on a Sunday. I know we typically put this out on a Saturday. I do appreciate you guys coming out to the show. So stronger sellers should have closed the singles, right? There's just virtually no volume commitment at price here. It's a void in price action. It didn't happen. That's a failure from the sellers. We take that as a bullish indication. And for the most part, you can see that Friday's session spends all of its time over the top end of the singles, right? So bullish here out of the market profile. We have an extremely poor high and a poor low on the Friday session. If we zoom in, do we see lack of material excess? Nope. Not even here. Maybe a little bit at the highs, lack of material excess at the highs, I period single print sticking out there, 1 TPO, and obviously with the ranges we've been traveling, you really have to zoom in. But that could use some repair. The highs and the lows, same thing. Lack of material excess in a market that's been flying around, multi-100 point ranges intraday. In the blink of an eye, you definitely want to see more excess than just a single TPO print like that on the market profile. So with that, let's jump back on over to the platform here. Let's take a look at our good friend, the Rusty Russell, on the monthly time frame chart. Let's see if it's Armageddon over here, because we know that there are still some concerns out of small caps, primarily coming from this previous balance range right here. There's no precision. There was no precise hold of this top end of the range. In a picture perfect world, it would have been Brigade Bolt over the top end, supporting the monthly 50 SMA as well. That did not take place. We've talked about the threats in the Russell for a while now. And I think that we will just maintain this stance in terms of saying it's not helping the case for the broad market, right? Obviously, any sort of rally rejections of around 200 put the pressure on to the downside, and perhaps this starts to tell the story of the growth recession that could be looming in the shadows here very soon. So we'll watch out for the rut. If it can get over 200, I think we would all rejoice. But for now, there's nothing compelling about the monthly time frame. If we take a look at the weekly time frame chart and see what's going on here, you can see again a little bit of that divergence in terms of relative weakness. There is certainly a green body bar, a little bit more of an upper wick than what we saw on the NASDAQ and the S&P, and we also see a little bit of a weaker close. Instead of closing towards the midpoint of the previous week's range, we're definitely in the lower third of the previous week's range there. So a little bit more work to do out of small caps. And again, the point is so long as we're underneath the threat of 200, the round number, it's the 200 SMA on the weekly time frame chart, it's just very, very difficult to get excited about long positions, long opportunities that support the broad market moving higher from small caps. Fib 38.2 is right on the money at the top end of the balance range, that 199-200 figure. So that's confluence there. If we come in from the lower high down to the low, notice that here we close completely underneath the Fib 38.2, not even in no man's land, and the wick did not even test the 61.8. So bearish here out of small caps. Let's quickly come in with our anchored VWAP set for the weeklies, and what we got to do here is grab a little bit more time just so we can get the prior all-time high and the low from back here, and just notice that there's no recapture, right? And as a matter of fact, this lower high threat out of small caps probably looks more compelling than what we have in the S&P and the NASDAQ. So if you're asking yourself, like, what should I be thinking about? Where should I be looking for longs? Where should I be looking for shorts? I think that the NASDAQ offers a great long opportunity, but the S&P is honestly better in terms of structure. If you're looking for a short opportunity, it's got to be small caps. It's got to be small caps. Just the relative weakness inside the balance range, great confluence here, rejections of 200, everything about that makes sense. Now, if we want a contingency plan and say, like, what would be the best case situation for S&P to recover here, go back to all-time highs and produce maybe even a new all-time high, and don't get me wrong, not this week, but over the course of time, you need to see the Russell over 200. If small caps cannot get in gear and start participating in the rally, you're just not going to have a broad enough based rally, in my opinion, to send the market back to the all-time high. You're maybe going to get a structural grind to the upside, but you would need to see the improvement here out of the Rusty Rut via some sort of Brigade Bolt up and over that level over the course of time. It could take 3 weeks, 4 weeks, could take 10 weeks. It could never happen. You never know, but we'll be watching that very, very closely. Based on all the indications we've seen so far, it looks unlikely for the week, given that we're rejecting some of these key areas and Fibonacci retracements. We could check in on the volume profile And this is going to look kind of wild because it's a 10-year chart. But where are we relative to, like, let's just map out the top of this high volume node and the bottom of this high volume node. This chunk is generally what I'm aiming at on the volume chart there. And if I just do that again, let me make this a little larger for us. Even if we draw in the bottom end, right, that's a perfect rejection of the upper wick of the weekly bar. Never, like, this is not even a conversation point up here at the top end of the high volume node. So is there still plenty of overhead supply that possibly can sell into this move? Absolutely. Absolutely, and it just ties in so nicely with this previous balance range. So there's some serious concerns out of small caps, and they would need to improve dramatically if we're going to look for a broader-based rally over time for the S&P to get back up towards all-time highs. So we're watching that quite closely, but for now, let's continue along with the analysis. You can see that there was no 3 equal highs. The Monday high was a little bit more sporadic, if you will, much more of a full week balance. So is there anything big to take away from this? I don't think so. I really don't think so. On the Wednesday session, the close up here starts to look decent, and maybe, you know, if we go on down to the intraday charts like this, we can start to see it with a little bit more clarity. This is just a balance range. I really think that you want to keep it simple out of small caps. Yes, it starts to look like maybe you could draw this in as a hourly, perhaps, inverted head and shoulders. It's possible. But what you would have wanted to see on the pullback here is support for that higher low. It just didn't happen. Or like the overshoot that was not even close to an equal low to what we had back here. So generally speaking, what the market needs to do for small caps is show some resolution of 183.50 and 176.50. If we're in here on just sort of like neutral, you know, market small cap doesn't care about the relief of the China tariffs on the technology components. If that's the case, then this isn't helping the S&P 500. If small caps can stay over 183.50, then great. Like, I would think that we have a thin structure retracement overhead up towards 190.25. What's the issue with that? The weekly threat that we just talked about here, which, you know, starts to come into play towards this zone. This is just a big cluster. What I would consider this is overhead power lines, right? Literally just like you have to be like, okay, this is possible resistance, upper edge of the weekly expected move. It's not always hard resistance, but beyond that, we have this gap fill reversal. We have the weekly key. We have that 200 figure. This is going to be a really, really tough zone for the small caps chart, in my opinion. And we'll learn something either way, right? That's always the beauty of price action. My first base case here would be, okay, if the broad market is going to grind higher, we'll look for this and we'll look for this. But when we get in here, I would start thinking about reversals. I would really start thinking about reversals. And like I said, we'll learn something either way. If the small caps blast right through this and set a higher low above this week, or let's even say, oh, look, it looks like I didn't even update the expected move here. Great, Matt. Awesome. Fantastic. We'll update that for you and post a screenshot of it over on X. If you're not following us over on X, make sure to do so. It's linked down below in the description if you're interested in that. But just to give you an idea, if we go to small caps here real quick, and let's go to this session, we have about a $9.82 expected move, $9.82. All right, so that would be, oh, let's just round it up to 10, so about 195 on the upside. So actually, this is going to be very close to the upper edge of the weekly expected move, and 175 on the downside. Roughly something that's going to look like this as your expected move, okay? So still power lines up here acting as resistance. That doesn't change the story. But base case is like, okay, if we do this, we start looking for rejections up here, roll back over. If we get this big Brigade bolt out of it, what's that an indication of? Something structurally has shifted likely, and maybe we have a clear shot at a better improvement, a better recovery out of the S&Ps. They'll be watching the small caps very closely as and if they get that upside grind. I would give it the benefit of the doubt, noting what's trying to take place with lows, higher lows. The broad-based market seems like it's in store for that. But when we approach the weekly lower high threats, I would not be gung-ho about shorting the S&Ps. I would be like, okay, the small caps, if you're going to do it, maybe it is worth. I rarely ever trade IWM options, but maybe it is worth stabbing some IWM options short on the potential rejection up here towards the weekly and monthly key level around 198. We've been pretty thorough in this investigation and pretty vocal about the weakness that's here. Here is the fib 38.2. Notice that the overshoot was under the 61.8, and we've just closed at the 38.2. So we're in no man's land here, which reinforces the idea that this should really just be treated as consolidation until proven otherwise. You got to get out of that before something more impressive happens in the upward direction. Let's check in on the anchored view apps to finish it off and be congruent. Intraday anchored view apps, they are starting to cluster near that 183.50, and lo and behold, just adding into the whole idea of the threat here at the 200 figure, it's right there, right? That's the all-time high anchored view app, close to the all-time high anchored view app. It's slightly different out of small caps, actually not even close to the It's the last high from, that would have been February, before the large drawdown started to occur. Okay, so just making sure we have all of our reference points squared away. Let's check in on the Russell side of the internals. It would not be shocking, right, to see that we had just sort of a muted day, not getting substantial on the volume flows, not closing as close to the trend higher zone on the AD line, although I do want to acknowledge the positive flip here. If you take a look at the cumulative build, solid, and again, a little update here in the face of the consolidation that's been taking place. Not terrible, but not out of the woods here from the internals point of view. If we jump on over to the Rusty Russell market profile, rinse and repeat, all the commentary. What you will notice here, actually, and I'm sort of amazed I didn't even call this out earlier, we were talking about it on the Friday pre-market prep. The Russell did close all of the single prints. So just another indication that squares up with the idea that there are definitely some weaknesses. There's some discrepancies between the big three, and the Russell is the weakest of the bunch. The sellers were able to actually do their job here and move through the thin structure retracement. All right. Aside from that inside day on the Friday session, we'll watch for a break, as we just said, over the highs if it's going to get in gear to the upside. If it's inside, it's just another consolidation day, and I'm not overly thrilled with that. Let's jump back on over to the platform. Let's get into our S&P sectors. Let's see if we can't get the job done here, get this video posted before, I don't know, noontime maybe. What do we see? S&P sectors. Let's take a look at the weekly performance. You are going to get a skewed view one more time because of the way that the script deals with numbers, but 16% out of the semiconductor sector, or industry, you should say. It's not really an S&P sector. We have the XLK tech sector, the heaviest weight risk on sector, up 13.39%, followed by industrials, and then underneath, I mean, you can just see very, very impressive reads throughout the week. Financials up there, communications, consumer discretionary. One thing I'll call out is just that the heavyweight risk on sectors are the ones that are performing the best here on the weekly performance. At the bottom end of the barrel, the only red thing on the list is the TLT bond. There's a couple of potential arguments around that, and we'll talk about it momentarily. But aside from that, your weakest performer is real estate, hard asset. That's typically a little bit more defensive. Then you have energy, healthcare, utilities. All of those are deeper defensive, and they're underperforming what we have here in the heavier weight risk on category. So with that, I would say posture is definitely in alignment more so with if this is going to be a capitulation low that is followed by a structural low that's risk on. The first signs are there. I'm not going to go out on a limb and say like, oh my goodness, this is it. We're going back to all-time highs in the blink of an eye. But green shoots are developing, and that's really the purpose of today's video, right? Green shoots have developed. We don't want to persist on the bear side for no reason if we're getting these structural elements that are required for a new uptrend to develop, and the news cycle has improved, and we're seeing outperformance from the risk-on style sectors, right? Let's jump into these. Let's just go top down through the list. XLI, does it have the opportunity for a higher low? The answer is absolutely. I'm watching 122.50. What we're going to do here is a speed round. We're going to talk about the lower high threat, but the higher low optimistic take. 122.50 and 128.50 are your two key levels out of industrial. So far, the chart looks fine. Let's take a look at financials. Higher low needs to stay over this area here at 46.40. Started to look okay into the Thursday open. Looked not so great through the Thursday session. Friday's close leaves a bit to be desired. Of course, we have JP Morgan earnings, which did not go so well the numbers were great, but the actual response from the market was lower in the pre-market. Then it rallied all day. So that was kind of interesting. You can see here up 4.37% on the session from the open. It's a matter of now just seeing some follow-up from Goldman Sachs early this week and some of the other financial institutions out of earnings to see whether or not we can stay over this 46.40. If we do, that would be really constructive for the S&P, noting that this is the second heaviest weight sector by market cap. Where's your lower high threat? It's really just Wednesday's high. If I do something that looks like this, it's your previous low from here. And if I zoom out on this chart, right, you could certainly make the argument that it's sort of the neckline retest of the head and shoulders. So 47.60 and 46.40. Those are your two levels that need resolution. Consolidation in here. It's not the end of the world, but it definitely doesn't give me a warm and fuzzy feeling about the S&P. Communications, similar story. You have 95 as your big resistance overhead, and 91 needs to hold as support on hopeful rallies here out of the Monday session with the improved sort of tariff news over the weekend. Moving into discretionary. Very clean here, where you have a big set of previous lows. Notice that the Wednesday punctured that set of lows. So it would be great if, basically what this is indicating, right, is that the sellers did not step up there for a huge rejection, and the improved news was enough to poke through that level. So walking forward, I would be a little bit more optimistic about resistance breaking and not holding such a high regard for 192.75. We'll watch it closely, but for now, the big deal is just staying over 188. If that's the case, looking for upside to become constructive over the course of time. Let's move on into our XLB. See what's going on with the XLB materials sector. Much more balanced. It's the lightest weight sector, so we're just watching the equal highs. A gap close overhead starts to look good, and then we would want to see a gap fill reversal, high or low over the 3 equal highs. So 81.30 and 82.85 are your key levels based on literally the previous structure off the left as well. Moving along to the XLP, consumer staples, D for defensive, back inside of this sloppy range. What I like about it is honestly the fact that it's holding up over, at least on Friday's lower wick, this 78.75. So all set out of that, if this was going to be more bearish, right, should have rejected here. And if it was going to be more impressive to the upside, if this was like going to be a risk-off rally that's being led by something like consumer staples or utilities, for example, maybe this would have been up and over this swing high. If everybody was like, if it was a true flight to safety, let's get into defensive assets and jump into staples, right? That's just not the case. You're not taking out that pivot high. So that's noteworthy. Let's move along to utilities. D for defensive. It is back inside of its range over here. Is it outperforming by any substantial degree on the percent return? No, not really. So all set, just sort of consolidation over the 75.85 looks fine. I would go out on a limb and say you could even get it here over 74.50 as well. This is sort of your consolidation. This is a little bit more constructive over the 75.85. Moving along to healthcare, has some work to do, but again, D for defensive. It is a heavier weight sector these days. All inside bars, all consolidation. Got to see the breakout over 138.75 to get into 143.85. That's the next big watch here out of the XLV. If it just consolidates in the range, I wouldn't really hold it to any particular outcome for the S&P. It would be a neutral factor for the S&P all up. Let's look at energy. Same concept, consolidation down here. It is looking more like price acceptance towards the lows underneath this overhead range. The only thing that this brings into concern is the growth story, right? And of course, if we take a look at crude, CL, it's the same idea with just this consolidation happening underneath the lows. You would need to see some sort of rally from crude back over 64 perhaps to start to indicate, okay, we're not doing so bad, and maybe the growth recession, global demand for oil is not going to dry up and completely go away. So 64 would be an interesting level to watch out of crude, for example. Anything that consolidates down here, we'll be mindful of the recession story, but I don't think that we want to trade based on that alone. I think that we would want to trade primarily off of the base case structural elements we've just talked about in the S&P cash market itself. Moving along to the semiconductors, you can see out of semis, the big overhead supply is way up here, and we've got this as well. That is the Wednesday high rejection. I do like the fact that on the Thursday-Friday session, we closed the single prints down into here, and you can even see the 195.15 that starts to emerge as potential support with the close above on Thursday and obviously acting as support on Friday, close near the high. I really like this SMH chart. If we take a look here, yeah, you have the overshoot, but there's plenty of opportunity for holding a higher low here to retrace through the thin structure and get into that 211. So watching semis, as long as we're over 195.15, thinking about retests of 212, anything over 212, rainbows and butterflies with the news over the weekend. Again, it's not going to be a shocker to see this stuff open on a gap up on the Monday morning session. You could watch for gap fill reversal strategies to hold up over Friday and Thursday's highs. Probably should have said this earlier on something like the QQQ. Again, even over here, right? Not going to be unreasonable to see a gap up. So gap fill reversal over the 2-day highs, and we'll talk about it on the Monday pre-market prep, right? That's the top of mind idea. Same thing out of the XLK, right? As long as we're over 190.75, your overhead threat is here at 206.40. I would start to lean into the optimistic take with the news headline. We're going to open on some sort of maybe mild gap up, gap fill reversal. If we do open up in range, it's just all about 190.75. Continuing to watch that for a hold. Real estate. Lightweight sector, a little bit more defensive, underperforming, consolidation in here. Not the worst thing in the world. It's actually offering a really great trade. Over 39 into 41 starts to look interesting for that thin structure retracement. TLT bonds, why is this getting smoked? There's a number of reasons. There's maybe a number of reasons for this. Generally speaking, the trend is down through here. It started to form a little bit of a counter trend in here. This failed breakout looks a little bit interesting over this high. And really what comes to mind for me is it's really twofold. Opportunity cost. I think that's something that I get it, right? And we're talking about bond auctions, and we saw that the German bond was catching a bid, and maybe foreign buyers of U.S. bonds want to get out of here. But one of the things that I'm thinking about is opportunity cost. Why would you want to? I get the reason why. It's flight to safety. But anybody who has a little bit more of an aggressive stance on the market and is maybe looking at the same things we're looking at here, monthly higher low, weekly has the chance for a higher low, daily's already starting to set a higher low. What about the opportunity cost of being out of equities and in the TLT? I think you started to see the threat of that on the Wednesday session when the market literally returned 10% plus in a single day's session. Now, I'm not saying that, everything's in the clear and all-time highs should be here and everybody should just rush into equities. But what about the opportunity cost of being in the bonds, the long bonds, when maybe this is the low out of the S&P? And I get it. Money managers don't think like that. That's not the way that you would position a defensive portfolio. I totally understand. Don't get me wrong. Didn't fall off the turnip truck yesterday, as we like to say, right? So I understand the defensive posture, but for me, at least, one of the things I'm thinking about is opportunity cost. Why would I want to be in the long bond when, it certainly seems lucrative that a low could be set in the S&P and we could start traveling and working our way back into an uptrend, getting a better return over there. So we'll see if that ultimately ends up being the case. At a certain point, when bonds start to move any lower than maybe 85, this swing low from here early in 2025, that is maybe a reverse opportunity cost where the yield just becomes so attractive, especially in the throes of volatility, where you start to catch a little bit of a bid, around 85 or below. But buying bonds at 94 with the S&P, on that pullback down over whatever it was, like 17% from the all-time high, I think a majority of people recognize that as a bit more of a possible buying opportunity than a selling opportunity. So we'll see. We'll see how it all plays out, but those are my 2 cents on the TLT based on opportunity cost. I think it's an interesting point that is not always discussed. It becomes just purely about being defensive. Well, what about the opportunity cost for your portfolio? Here is the ratio grid. Green shoots out of risk on here. This looks okay. Green shoots from much longer ago, and I like the fact that this higher consolidation is just taking place. It would be best if we broke the 50 SMA walking forward here. XLF, green shoots holding over the 50 SMA. The XLV is kind of neutral in here. It's really not the worst thing I've ever seen. If we look at the XLC holding in there sideways, I'd say neutral. I would say neutral over here. So there are things that need to improve. So I'm not pounding the table for, again, new all-time highs. The risk on rotation is here, and oh my God, let's go. We should be here tomorrow. But green shoots, I think, is the call out that I've been pretty clear about, right? Watching very closely to see if this lower high persists out of defensives here and here. And if it does, that would start to confirm the rotation back into more of the risk on assets. If we move into the specific ratios here, green shoots off the lows. I like the higher low into the Friday session. Green shoots off the lows. I like the higher low here. And again, point being is we're acknowledging that this is still in a downtrend. Please, don't mince my words here. They're still in downtrends, but I like the beginning stages. The fact that on the week or the end of week here where the market rallied, we're finally seeing some improvement out of these specific ratios, these relationships. This is not as encouraging out of XLY, XLP. It's sort of just sitting on the lows still. This is sort of iffy, a little bit more neutral. A little bit of an upswing out of the low from the ARC K, but not, again, as impressive as what I would think this is doing and this is doing over here. Really more so focused on those top two. If we jump on into the Dixie and take a look. Actually, you know what? I'm going to have to reconfigure some of these charts, and this is one of the things I'm learning over the past couple of videos. I want all the risk on, risk off stuff to be chunked as one. I don't want to come back to the TLT ratio after looking at the fundamental take. Here is the gold ratio to the S&P. This is a small shot across the bow, and I think one of the things that's driving this actually is just the collapse in the dollar. So gold and the dollar are somewhat intertwined, of course, just as you express them as currencies. Look at the collapse in the dollar. Something about that. There's a bunch of circulating stuff online. Oh, something's broken. Some fund is going to go under. I don't know that I would take it that far, but it certainly seems systemic or structural or something more than just supply and demand dynamic here out of the Dixie, just breaking down so aggressively. The dollar should not be moving with this much volatility, to be quite frank. If we take a look at things like let's go to the 6E for the euro. Euro has been taking off, right? So obviously as the dollar weakens, the euro strengthens, and you're seeing improvements in these other currencies. 6Y for the yen. 6J, apologies, is going to be our yen. A little bit of an uptick over here. And these are weekly bars, FYI. So generally, this is one of those warning signs, and the contingency plan that we would have to have out of the S&P basically is if we look at the Dixie, if there isn't some sort of rally back in here, that would sort of become a little bit of a concern, right, for excuse me, the strength or sound nature of the financial system right now. So I'd like to see this cool off and not continue to fall off of a cliff. But ultimately, let's not also forget about the relationship of like a cheaper dollar, so to speak, improving equity pricing down below. You could make the argument, right, that a stronger dollar should shave off some of the earnings power of the of S&P constituents. Let's jump into our TNX. Start talking about interest rates. No, what did I just said? And you guys can tell, right? It's a Sunday morning update video. So we're gonna get back on track for our normal scheduled broadcast, a little bit more organized. I feel like I've been a little scatterbrained in this episode this morning, but TLT ratio to the S&P rolling over here. It seems like the risk off spike is mostly over, and people are starting to favor equities once again. So a little bit of it's a push and pull. It's a tug of war between the indication from the gold ratio and the TLT here. But generally speaking, the structural high or low out of this makes the most sense to me, given all of the data points we've looked at so far. It looks like we're getting green shoots. We just want to make sure that those shoots ultimately bloom into something beautiful. Here's the TNX. What a whipsaw out of bonds, right? We saw this on the TLT anyways. So as rates start to become maybe more attractive, I'm not calling for 4.8 the equal high, but just put it out there. Anybody, Uncle Joe who just sold his 401k, if you say, hey, you could collect, 4.8%, quote, risk-free, and not have to deal with this volatility, he's probably like, yeah, count me in. So I think that the opportunity cost inversion probably gets a little bit more exaggerated as you get closer to 5% on the 10-year. Seems like the next thing you would want to watch for here is whether or not rates could get back down underneath about a 4.375 or something like that. If we can get back below that on rates, I feel as though the market's going to find some comfort in that. As in, if rates continue to blast off to the upside, you might actually see the bonds catch a bid there as we approach 4.8 or beyond into 5%. Let's jump on into which would of course be bearish for equities. It would keep money from flowing into equities would be the argument there. Let's jump on into the inverted ZT, the 2-year, getting a little bit of a move in the upward direction. And we know that with the relief on some of the tariffs, I think that Jerome Powell and the Fed are a little bit less concerned about having to intervene, things breaking, and so on and so forth. They are continuing to cite the minute-by-minute liquidity. So if we just flip on over here, actually, let's go to the Fed Watch tool as we talk about this. The Fed had a bunch of speakers come out, and we'll continue to see some Fed speak. But CPI print, great. PPI print, great. I think that the Fed's looking straight through those reads. We've talked about how if the tariffs are truly going to cause inflation, we're going to get the first signs of that in the May reading. So April's prints, which of course were reflective of the March number, not really something that the market cared all that much about. And you honestly saw that in the pre-market reactions. They were almost unchanged when the news was released. So we'll watch out for that. But the Fed tracker tool, as of right now, lower odds for the cut coming in May and higher odds back to the pause. It still looks like 1, 2, 3, and not quite 4 cuts into the end of the year, but just 3. 3, and then the 4th coming early in 2026. So the fewer cuts that we get, the more confident I think the market is in terms of seeing the resolution of this volatility that we've been getting recently, and maybe avoiding the dirty R word, the recession word. So we'll see if that ends up being the case. Let's do a quick recap of the fundamentals here and see what we can see. We've got ourselves, where is it? Here it is, CPI. Let's actually take a look. Yeah, let's take a look at this calendar. I like this one much better when it comes to actually showing everything. So the core CPI are the first 2 here for the Thursday session. And what we care about is just the fact that we beat the forecast. So 0.3 on the month over month and a 3% flat on the year over year. We beat at a 0.1 and a 2.8. That, of course, is a decent indication. But once again, the market's looking through that, trying to see what the April prints look like as a reflection of the tariffs now that those are officially in place. The non-core also on a beat, getting a little bit of deflation here out of the month over month, and the year over year moving down to a 2.4. As we look at initial jobless claims, this as well is something that we should focus on. Let's click into this for a moment. And let's continue to just point out that your initial jobless claims have not really gotten out of hand. They're well within line of normal reads out of jobless claims. So you're not going to get a deep, dark, dirty unemployment recession if this number doesn't start to get out of control. And honestly, you can go back. You could probably look at the Fred data set. It's going to be easier, and it will shade the recessions. Typically the full labor report is going to be a lagging indication, but the jobless claims, the initial, the week-over-week prints, I don't want to call it a leading indication because the damage has been done. These people are losing their jobs, but it's going to fire off slightly before the recession typically is called, right? You'll see the uptick. And of course, the recession's always called in hindsight anyways. If we look at continuing claims, you're going to see something similar where you're not really getting out of hand here. If anything, there was a little bit of a subtle downtrend that was happening here, and now you have these sort of like seasonal discrepancies where every other week things start to tick higher, but not to the magnitude where we're saying there's a big breakout in continued jobless claims. If we go back to maybe not max, let's go to a 3-year. We try that, do that for free. So we're just watching this very closely. I think that the level is elevated, right, relative to what we have in the rearview mirror. But if we do this, right, this is the sickness, obviously. That's the sickness, unemployment, recession. Oh my God, growth is going to go to zero. The consumer is going to crumble, right? We just don't have nothing remotely close that looks like that, right? So anyhow, that is your jobless claims from the Thursday session. If we take a look at Friday's PPI, this was the big deflator. You got the negative impressions on the core and non-core on both the month over month and of course the year over year, moving down about 0.2% there on that, and over here on the non-core getting down, what is that, 0.6% out of that. So for the most part, improvements. Consumer sentiment came in horrible at a 50. Forecast was for a 54, as you can see over here. So I think when you reach the pinnacle, and this is a conversation point to tie into the fear and euphoria cycle that we talked about, the consumer sentiment survey asks people how they feel about the market or about the economy, basically, right? People who are currently responding like, oh my God, things are as worse as they've ever been, is that person holding on to equity, or have they already made the decision to sell long ago? They've probably already decided to sell. So at the worst of the consumer sentiment reads, when things like really get dire, I don't think that, the takeaway here would be that the reads, of course, are going to look the worst at the low. That's like undoubtedly what should happen. And we just went through the low, basically. So if this number even sees a subtle improvement into the following print next month, not the revised print here, but the next actual preliminary print, I think that's another decent indication. The inflation expectations also ran sort of out of control here, a 4.4 on the 5-year, and if you look at this one, 6.7 based on the prior at a 5%. So people really concerned about the inflation aspect. Again, I think that the expectations, you got to play that game a little bit, right? Expectations can lead to actual inflation, but it's always going to get the worst at the low. That's something that we need to keep in mind. And I think we're seeing that right now. That's my argument, which is why we're looking through this stuff. So, of course, the headline, that's changing things over the weekend. If you want to read it, you can fire it up. Just search for exemption on tariffs. Exempts phones, computers, and chips from new tariffs. And that, of course, is after the 145% tariffs, which were applied to China. So that is going to give Apple, of course, a big boost as we come into the Monday open. And I generally think, once again, if we think about that fear and euphoria scale, the FU scale, we're moving towards the U side. We're getting away from the max fear side, and that is typically indicative of lows. We've talked about it quite a bit. Now I feel like I'm rambling a little bit. Let's jump into the earnings cycle. And what we've talked about over the next couple of weeks is seeing how many companies withdraw guidance. And I love that this is called out here, because not to say that like, oh, we're the only ones talking about this. I think a number of people are talking about this, but it's good that FactSet is going to call it out in their report so we can keep tabs on it. The number of companies that withdraw earnings guidance typically increases as uncertainty increases as well. You could think back to the sickness, right? If you think back to the sickness, and they're even referencing it down here, nobody knew what was going to take place. So everybody was pulling guidance. And what does that mean? It just means that there's either extremely low confidence about the future, or like we literally don't know, and it would be inappropriate to guide anything. Like everything's subject to change. It's not even worth doing. So that representation of max fear is going to sort of align with our tariffs as we head into the earnings cycle, and we hear from companies. If we see earnings get pulled, that's not a good sign. If we have earnings that remain intact, or I shouldn't say earnings, but rather guidance that remains intact, then that's kind of okay. Remember, even negative guidance is better than no guidance. Why? Because it sets the stage for what the market should expect. If the company thinks, okay, we're going to guide down, and then they either come in at the expectation, then great, everybody expected that anyways, it's no big deal. If they beat the expectation, then guess what? The stock is likely going to rally because you have some sort of beat to the pessimistic outlook. If there's just no guidance whatsoever, that's your red flag. So you can see that 2 companies so far have withdrawn or not provided guidance going forward, and 14 have. So we'll watch this number. We'll see how this continues to play out, but that is what we will be thinking about through the beginning stages of the earnings cycle. The financials are the ones who primarily have reported. This is what we've got next week. It's Goldman Sachs. It is Citi, Bank of America, J&J from the consumer staples side will be interesting. A lot of honorable mentions here. Let's put some boxes around some of these players. These guys in here will be interesting. IBKR for anybody who's on that. Hopefully your commissions are pumping the stock price and you own the company. ASML is our first taste of semiconductors. If we look at Abbott, the healthcare sector, we'll get a little bit of love on that. I would say CSX, all the rail companies usually have something interesting to say, just like FedEx and UPS would typically. TSM is our second taste we have of semiconductors, that is. We have United Health on the insurance/healthcare side of things, and Netflix is always our first culprit for the Mag 7. So watching these quite closely, I would primarily be concerned this week with TSM. If you said, Matt, you could only pick one name to watch for, it's TSM. It's got to be. It has got to be. With that, let's jump back on over to the platform. Let's finish up our look through everything we typically do. Bonds relative to themselves, the shorter end of the curve getting a little bit of love just based on the longer end of the curve falling down, or these are bonds technically, so it's the inverse, if you see what I'm saying, right? We saw the TLT falling off of a cliff towards the lows, which is why TLT ratioed to the IEF. The shorter end is getting a little bit of outperformance here on a relative basis. Anyhow, this would just indicate that the market is unwinding some of the work it was trying to suggest that it was doing for the Fed, in the case of the Fed, right? Let's move along to credit spreads. I would like to see these lower highs stick on the nuanced indications, and I would like to see lows made equal to the origin of these breakouts. If that becomes the case, that would be much more constructive for the market moving forward. It would be a bullish indication there. If we take a look at junk bonds by themselves, it looks a little bit more like the IWM in my view, where we have this type of action going on. This is sort of your balance range. So watching the HYG, it's not divergent in the sense where, I'd be thinking about massive collapse and let's not trust the SPX. We're not at that point yet. If we look at the LQD, this did get a little bit of that lower low into the end of the week. This is not a warm and fuzzy feeling. So once again, there are some threats out there in the market, and we're watching this, but I would say it has to be paired with, we can carry this forward as a slightly bearish data point, but it would have to be paired with, no ifs, ands, or buts about it, some sort of Brigade bolt lower high underneath 523.75, and now we're like, okay, this is no good. This is not healthy for the structural low thesis that we've set forth so far. Let's jump on into the Bitcoin chart and see that the risk asset Bitcoin, honestly, did not break down aggressively whatsoever. It's looking like a pretty solid retest of the previous structural highs back here, and hammer on the weekly. If we can get over that hammer high, maybe this starts acting as a double bottom. You could long it back into the consolidation range overhead, looking for follow through over the 100K mark. Bitcoin really just putting in some decent consolidation here rather than an aggressive pullback, which is fairly the aggressive pullback outcome is fairly normal for its cycle. It's not uncommon for Bitcoin to have a 50% drawdown, right? Sailor shift ratio not firing green yet, so carrying that forward as maybe a hesitancy on the long side. Let's go to total breadth. Decent improvements here and here. And if we take this down to a daily chart, just so we can get a little bit closer, notice that it is higher lows into it's not just like a straight up one of these V's. There are constructive higher lows on the day by day, as well as here out of the moving average cluster, although it would be best if this could work its way back up to the 50% mark. Let's jump on into RSP. What do we have over here? It'd be best if we could stay over the 161 and get some of this thin structure retracement going overhead. That would help the narrative for the S&P to broaden out and continue the rally in the upward direction. Same comment over here in the equal weight NASDAQ, saying over 81.25. So far, looking pretty darn good as of Thursday and Friday's session. Let's jump on into we could look at the industrials versus transports. We haven't looked at this chart in a while. They're in sync. I would not say that there's a major divergence here. You still have the lower high. You have the lower high. Relative to this, I would say that transports are maybe just a hair weaker. Not breaking out over the multi-day high as the industrials have up overhead. Let's jump into volatility. This is maybe one of the things that everybody's waiting for. This is a threat. This is still a threat. Let's say ding, 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 winner, winner, chicken dinner. If you're a bear, this is where you want to pay attention, because For all of the rally that we've seen off of the lows, you would think that the VIX would collapse and capitulation would be like, okay, we're out of the woods, done, fine, no problem. And that very well could be the case on the Monday open with the new headline over the weekend. But I would think that with this improved hold on the Friday session, volatility should have been collapsing. If you take a look at what actually happened, it just simply didn't. And you might make the argument, well, VIX is broken. Nobody trades SPX 30-day options anymore. The VIX is not a good read. Well, all right, let's take a look at VVIX. Volatility of volatility. That did not break down underneath the lows as we got a constructive hold in the S&P over the top end of the range. If we take a look at the one-day VIX, which has really been instrumental through this, it's still inside of this consolidation range. So are we out of the woods from a vol perspective? I don't see it here based on what's happening in the one-day VIX. It would make much more sense that as the market broke out on the Wednesday session, here's Wednesday, 4-9, right? It would make sense that this should have collapsed if that was truly it. It seems as though what this is suggesting, right, is that, and this honestly, you could take it both ways, which is wild to say, but it is true. This means that people are potentially holding on to their hedges. And if folks are holding on to their hedges, that means that maybe there's still some short bias out there in the market, which is fine. But what does that do for longs, right? As shorts squeeze, it fuels the fire in the upward direction. So I don't want to sort of like try to bend the narrative too much to try to fit the bullish bias that we're looking for this structural higher low to form. But if the Monday open and the headline over the weekend is enough to bring the one-day VIX back down to earth here around 2145, 1275, the midpoint of the range, that would be a little bit more constructive walking forward. We are still looking like we're in a backwardation here. You could see that on the Wednesday session, there was a big improvement, but we fell out of that. Or I shouldn't even say we fell out of it, but the improvement waned as the week wore on into the close. We never even got into a contango up here. If we go to the trade tab, we can see this through the VIX futures curve. There you go. What we're looking for is this line to bend the other way. Oops, there we go. We want a convex curve, right? We want something that looks like that instead of concave. So if this is the case, we have lower risk in the present day versus some unknown future. The market is suggesting the opposite right now. There's more risk in the present day than some unknown future about a year plus out. So still not out of the woods. And again, it seems as though this is an indication that people are still holding on to their hedges and are not willing to bend the knee yet to the market moving in the upward direction. Could be interpreted as both ways. One of the things that I will take out here is the good friend skew. And skew, typically as it hits a low around 113, is what we're looking for everybody to throw the towel in and say, okay, out of the hedges, no big deal. Let's move on with our lives and start getting constructive on the broad market, right? Generally, the skew represents the difference, right, in the out of the money, far out of the money volatility of options. People hedging their bets, black swan indicator, you could say. So when it's elevated, people are fearful of a black swan. When it's down at 113, black swan's over. We're not quite there yet. And we'll watch to see if that capitulates this week. Let's jump on into the core list of companies. If you're still with me, drop a thumbs up on the video. If you're not, then you're not here. Let's jump on into NVDA to kick things off. Very constructive, just like many of the other things we've seen so far. I like the fact that the higher low on Thursday is holding over the 104.75, previous pivot low from back over here. Any consolidation in this range looks great. Brigade bolts over the Wednesday high. We'll look for upside. I don't know how you would remain more bearish on this chart unless there's a failure underneath 104.75, in which case this will act as a lower high, right? Let's not lose sight. Like, you could still make the argument you have trend line, you have sort of like trend line that looks like this. It could be a rejection point here. That is very possible, and we're still underneath the daily 50 SMA. But with the news about the lack of tariff on semiconductors, electronic components, right, I would tend to think that that's going to be some relief to NVIDIA, and it wouldn't be unreasonable for the market to either stay over 109.25, produce the consolidation here and get over, or just open on a gap up on the Monday morning session, in which case, once again, gap fill reversal is the main idea here. Where the concerns emerge is like, okay, we open on a gap up, we get acceptance inside the Thursday-Friday range, and then we're probably looking for bearish opportunities here. Brigade bolts to the downside, start walking the risk-reward down in the downward direction. All right, that's that. Microsoft. What do we have? Possibility for a big daily mosquito pattern. There's your proboscis. Just got to form a higher low over here, up and over the 377. So far, so good with Thursday, Friday's combo. Consolidation looks great. Brigade bolts over the highs. Target the weekly overhead supply, 403.25. If we zoom out, we recall that this is from this stagnation period that we've been sort of dealing with for a little while. If Microsoft was able to find strong enough new money buyers who are going to persist here, this higher low becomes constructive for that pattern, and the daily trend will change back to up on the Brigade Bolt over the neckline of that pattern, 392, right? So all set on Microsoft, bullish through here. Looking for this if there's going to be follow through. If there are going to be sellers who step up and say, nope, rejecting that daily 50, you're just going to have to see price acceptance here underneath 377.25, then it's game on. Like, don't get me wrong, I'm willing to trade the shorts here. It's game on underneath 372. 372. AAPL is going to get some love on the headline over the weekend. I'm not even going to speculate as to where this gaps up. Generally, wherever it gaps up to, if it pulls back and can hold up over 200, that would be really constructive. Something that looks like this, set a higher low outside of this consolidation, looking for a move in the upward direction. Next up, Amazon. What's going on with Nancy? Threat for a lower high here, 192.25, is still on the table. We'll see if this is impacted as much by the gap on the Monday session, perhaps. Generally speaking, I would want to see this start to do a couple of things. If it consolidates here, Brigade Bolt over the 2-day high is along through the Wednesday thin structure up to 192.25. Reevaluate when we get here because we have not punctured into the overhead supply yet, whereas something like NVIDIA certainly has, Microsoft certainly has, right? And those have that opportunity for the head and shoulders inverted, but Amazon not so much. So give 192.25 the respect it deserves. There's maybe a long trade to get there, but when we get there, very possible for a pullback. If we set a daily higher low and reattempt, now at a certain point, you can only knock on the door so many times before someone opens up, and we're really targeting the equal highs from back here, the moving average cluster as well. Google looks pretty interesting off the lows. Reason being is that the consolidation is really acting as very clean support. Thursday, Friday here. So I like the fact that this could be a nuanced inverted head and shoulders. This, as long as it holds over 157 or Brigade Bolts over 157, starts looking for the bottom end of overhead supply. This previous pivot lower high, at 170.25, and that's what we would have to the upside. So really thinking about consolidation, Brigade Bolt here, getting into some of those upper levels, thin structure retracement on the upside. If it's going to fail, then obviously look above and fail on the balance range here. This is a multi-day range. Under 150, 175 but rotates to 144. Next up, we have the Metaverse. Metaverse is not looking as hot with the move back down underneath its key pivot at 554. So I would maintain a little bit more of a bearish stance here out of the Metaverse. We'll see where it opens. Whether or not it's a gap is to be determined. I would say any opens in here give us the opportunity for shorts. And honestly, this was looking like the better of the short opportunities on Friday with the rejection of the Thursday low, right? Thursday produces the Brigade Bolt here intraday under 554. Friday being underneath the previous day's low, that combination, it's just relative weakness out of Meta here, I think is what I'm getting at, whereas many other things on Friday actually produced a higher low on the bar-to-bar count, right? So Meta, it's got some weakness, it's got some threats under 554. I think the bears remain in control, and we can look for some of these rotations to the downside. If we're over 554, then yeah, like everything else, if the broad market's moving higher, maybe you could fish for Meta, but honestly, I would prefer to take one of the stronger long-looking setups if the market's bullish on Monday. If the market's bearish, I would focus on Meta saying, no, this is your rejection, right? I would look for shorts out of Meta. So use the broad market to gauge whether or not you want to participate in that one. Here is Tesla. Balance range is widening out, broadening out instead of just this as a balance, and the break and Brigade Bolt here. Now it looks like this is maybe going to act as our weekly double bottom inside bars on the Thursday, Friday. Keep it simple. No need to overcomplicate this chart. You have a very minor helper level in there at 260.77. My goodness, how could we let that fly? We missed the IWM, and we let a 277 on Tesla? Goodness. You got to get over that for a Brigade Bolt, and then you're starting to talk about 286.85 moving average cluster as your target. That's the neckline of the double bottom. If it's going to just chop around and be, quite frankly, ugly, I would just, anything that's down here, I would not be willing to participate in Tesla, especially ahead of earnings. That's going to be early, not this week, but the week after that. Let's jump on over to JP Morgan Financials. Earnings on Friday. Again, not bad. Opening on, the intent was a gap up. If I just throw on the pre-market session here for a second, you can see it. The intent was for a gap up as we were up here, and then things sort of fell apart as the conference call was unfolding. So the fact that it rallied back and closed strong is not a bad indication that's there. If we just go back to JP Morgan, but I would think a couple of things to make note. Market moved into the gap overhead, didn't really find acceleration or like thin structure retracement through that, and sort of struggled near the highs. Walking that forward is a slightly bearish data point. Slightly bullish, though, is just the fact that we're over this previous pivot low from back over here. If we get consolidation above, I would maybe try to maintain a little bit more of an optimistic stance for the upside. If not, then just falling into consolidation and ugly nothing land. Let's jump on into Netflix and see what's going on with Netflix. As we look at this, you can see that you have a big level at 950.25. As long as we are underneath that, I would not be optimistic about Netflix. I don't think that there's a reason to be. I would think that generally speaking, this is all just ugly consolidation, to be quite frank. The Netflix chart has been kind of a crapshoot here and there. We could take a poll maybe over time as to whether or not we want to continue to keep Netflix in the lineup or not. We've got a couple of trade ideas for you. The first one's going to be on Disney. DIS is the trade idea here. And the major watch is just the fact that this balance is very, very clean, and we have a thin structure target overhead. If we do something that looks like this, actually, sorry, what am I saying? Disney is a short. Disney is a short. My apologies. I'm like thinking about two setups at the same time. We have we have a big breakout that has failed and the lower high inside. I would say any rejections of 86.60 rotate to the bottom end of the range. Disney, if we are going to fall into a recession, is one of those categories where nobody's going to go out to Disneyland if you're scrounging around for pennies to try to find enough coin to pick up groceries for the week. So Disney underneath 86.60, looking for 81 on the downswing here, and that is the chart we are dealing with. If it gets over 86.60, maybe you could watch it, but generally speaking, the downtrend here has been far more aggressive. The Friday session was not an improvement over the top end of the balance range, and the chart never even got close to retracing up to these prior lows. As we take a look at the next idea, it's going to be on HD Home Depot. What do we have over here? This one's definitely on the long side, I'll tell you that. You can see that we have all of these equal highs. This is the improper end of the auction. It is a poor high. So if the market wants to see a move through 355, I would be looking for a breakout into 372. If that can take place, it's also a multi-inside bar breakout. We have an inside bar on Thursday. We have an inside consolidation day of Thursday on Friday as well. Over 355, 372 becomes the upswing target. Here it is on the hourly chart. You could also make the argument that we have very steep, oops, that's kind of a wrong anchor there, very steep trend line building this out as an ascending triangle as well. So Home Depot is on the long side. Let's move into Honeywell, HON. And it's going to be a similar situation, but an even better thin structure retracement overhead. This is thin. There's nothing there. So as we just saw on the hourly chart, there it is. You could start to talk about this through the lens of maybe cup and handle. You could call it a big higher low double bottom. You could call it ascending triangle with a flat top breakout. Doesn't matter what you want to call it. As long as the next higher low is over 194.25, consolidation here, Brigade bolts over 199, bring you into this area up around the gap close, which is around 206.20. 206.20 could be our potential target as the gap close. Let's just throw that in there as a yellow line. And then we will finish up with two more. We have, let's go to the boring one first, which is just Nike. Nike is just a very clean balance range, which is the only reason why it makes the cut here. Amidst all the volatility, to see Nike just doing this, okay, worth paying attention to. It'll either be a Brigade bolt into the thin structure gap close overhead or anything that's underneath 52.50. No dice, looking for follow through in the downward direction for this thing to just sort of crumble a little bit. What would be the next targets? I don't even know on the weekly chart if we can see anything. Kind of crazy here. Let's go. Next target would be around 48.85. 48.85 out of Nike. Kind of abysmal to the downside, but that is the reality if that balance breaks. And then finally, this one's a little bit more exciting. PLTR, Palantir, our good friend. If you made it to the very end and you're seeing this Palantir idea, hopefully, it was well worth it. So appreciate you coming out on a Sunday. I know we were unable to release this at our normal scheduled time. It's all right. We're getting the job done. Look at the multiple inside bars. Look at the fact that Palantir is already inside of this consolidation, if not threatening a break through this area of resistance at 90.75. I mean, come on. Just the relative strength out of Palantir right now is pretty astounding. Any consolidation over 84.75 is bullish. Brigade bolts over 90.75, looking for this equal high at 97.55. Then beyond that, I mean, we're really starting to look back at targets here from the earnings volatility after the breakdown at like 107.75. Let's just, use round numbers. You guys know the rules up here in the office. That's kind of your next major zone to be watching for. So that's Palantir on the upside based on relative strength, and that is going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, if you are like, Matt, release this on a Saturday so I can actually watch it in time for the market to open, let me know in the comments section or by giving the video a very simple thumbs up. Remember that we will be live at the 8 o'clock Eastern time on Monday morning for our normal broadcast of the pre-market prep. We hope to see you there so we can build a game plan together. With that said, have a green trading week, and I will see you in the next one.